Okay, so the new standard which we are going to do today, it's a short standard IAS 20, which is called government grants. Actually, what they have given you in this book, in your SBR book, that is very short. If you can see that it starts from here and it ends here. That's all. And then they come to the next standard borrowing cost. Of course, it's not very long standard because from practical point of view, this is less. It has less application. Not all the commercial organizations they are engaged with government grants, and therefore they give less material. Uh, in fact, they have also given less explanation. I will upload my slides, and I mean there are something like 15 or 20 slides. You will see them in your section. Uh, as far as explanation is concerned, we'll try to do it quickly. We'll not spend a lot of time because as you see that your book is also giving less focus on that. Let me first explain you that how does this work. Let me create some space here. Government grants. So what is the case that government sometimes provides some sort of assistance in form of subsidies or grants to different organizations for different purposes. Like there are some activities which government wants to promote and government wants to assist those businesses who are engaged in those activities. Sometimes they create some special free zones and government wants to attract businesses to come and start operating from those free zones. Probably if you have some kind of shortage in food stuff, so government will start giving some kind of assistance, government grant to those people who are into agriculture. The same goes with education and etc. So government grant is kind of an assistance, a financial help, a financial assistance, which could be in form of cash or which could be in form of assets. You should remember that tax breaks are not included in government grants. Like if government is giving some kind of tax break, like some particular field of business if you are in, and they say that you are free from paying tax, that is not considered as government grant. Government grant is a real contribution, and that real contribution could be in form of cash or in form of assets. I'll start with a very simple example so that you understand the situation. Let's suppose that the government wants to promote, IT in school education at lower level. So you've got a small school where you are teaching children or kids from the age 6 to 12 or 15, the first primary school. And the government will say that we can give you 20 computers free of cost. But in return, you must teach probably 1,000 students. And you should remember that government grant never comes unconditional. Whenever grant is given, there is some condition attached to that grant. You must follow those conditions. It would never be like this, that government says that take this $50,000 or they say take 20 computers. It would never happen like this. When they give you $50,000 or they give you 20 computers, they would require you to do something. And now the question, what comes in here? Now, as I told you that in my slides, when you will read, I will upload those slides. They contain much more material than given in this book. You would see that what is included in government grant, what is not included in government grant, etc. But for the sake of your syllabus, what we are going to discuss here, we need to discuss the accounting treatment of government grant. How do you do the accounting treatment? How do you show it in your books? We have to talk about the recognition. And we have to talk about the accounting treatment, which means the measurement and the recording. So recognition, you should always remember the basic rule that you recognize when the conditions attached to the grant are fulfilled. As I told you, that the grant could be in form of cash and the grant could be in form of some asset. It could be in form of cash, or they may give you some equipment, some assets. Probably in agricultural, they give some agricultural equipment. They give some harvesters, they give some tractors. Government says we are giving tractors to the farmers at a low price. Like the normal price is $20,000, we are going to give $10,000. $10,000 government will contribute. Government will give subsidy. That's an example of government grant. Or they may say that we will give some other things lower at a lower market price. So when do you recognize that grant? Let's suppose they give you $20,000 or they give you a tractor, whatever. When do you take it into your financial statements? So the answer is recognize when the conditions attached to grant are fulfilled. Until then, it remains as a liability. So this is what you should, the key bottom line I'm explaining you. For example, if I received 20 computers, or let's suppose $20,000 in form of government grant, and in return, I must teach 1,000 students. So I have received $20,000 grant. And in return, we must teach, I don't know, 1,000 students. So if we have not taught any students yet, this 20,000 will remain in our liability because we promised to teach 1,000 students. And then you can consider that how much grant is per student. Let's suppose the grant is $20,000 divided by 1,000 students. So you can say that you have been given $20 per student. So as you are teaching students, you will see in first year, you have taught 100 students. So you can recognize 2,000. Then in second year, you have taught 200 students, you can recognize 4,000. So you calculate whatever part of the commitment you have honored, that you would recognize. The second thing is, how do I recognize accounting treatment? where to write this. So there are two approaches. Actually, historically, there are two approaches. Now there is only one. Historically, there are two approaches. One is called capital approach, and the second one is called income approach. Capital approach means that you take it as equity. You consider that it has been given as equity. Not preferred. This approach is not preferred now. I mean, this is an approach which existed some 10 years ago, but it is not recommended today. Equity approach, you say that, this is the money which has been, you can take it to your equity. You say debit the non-current asset, 20 computers, or debit $20,000 cash, credit equity. Because you say that it has come into the business as investment. It has come into the business as part of capital. This is called equity approach. The second approach is called, and they say that it is something which has been given to you in form of capital. But second approach, income approach, it says that take it in your statement of comprehensive income as revenue or income and show it through income statement. Don't take it to the balance sheet, take it to the SOFP. When I say capital approach, it means that I'm showing it in SOFP, like balance sheet. If I'm taking income statement, it means I'm taking it to the income statement of comprehensive income. And the reason behind income approach is they say that grants are earned. This is the concept, and this is true. This is true because you earn grants. When you said that out of 1,000 students, I have taught 100 students. So if you say that 100 students I have taught, and you want to recognize it as revenue, like 100 multiplied by $20 is equal to $2,000, you should charge as your income, as your revenue. Why? Because you were meeting some conditions. Government grant was not given to you for free. They told you that we are giving you computers, but you must teach. And in order to teach the students, you were paying salaries to your teachers, you were paying rent of the room, you were paying electricity. So you were incurring the expenses, and expenses were incurred. Expenses were incurred to meet the conditions. I mean, they never gave you unconditional. They gave you based on some conditions. And in order to meet those conditions, you spent some money, you had some expenditures. Those expenditures, you were showing it in your income statement. And naturally speaking, the matching principle, the accrual principle, because expenses are coming into the income statement because of these conditions, therefore I must show it to the income. Now this income approach, it is something which is preferred. This is which is preferred, and this is which we will follow. The first one, capital approach, also had some argument, but those arguments are weak arguments. Like capital approach also has arguments. I wouldn't say that it does not have any support. It also has some kind of support, but that support is weak. The arguments in favor of income approach, they are much stronger and they win. And therefore we use the income approach. So what you do, so what you should be doing, let's suppose, when you got the cash, you say debit cash, like $20,000, whatever you received, and you would say credit deferred income, $20,000. So you record your asset in form of cash and you record your liability in form of deferred income. So this 20,000 is that grant. And then when you are teaching some students, you say debit deferred income, whatever you taught 100 students, so $2,000 debit deferred income and credit revenue. So slowly and gradually you are ready. So when you say debit deferred income, it means decrease in liability, and credit revenue means that you are taking it into income. So gradually you are decreasing your liability. Initially your liability was 20,000. Now you already have performed some part of the job. So that can be recognized. So you would say debit deferred income, decrease your liability, and credit revenue, take it to the income statement. Because when you were teaching these 100 students, you did spend some money for teacher salaries, for rent and electricity, etc. Expenses are in the income statement. Revenue should be in the income statement. So this is the government grant, the general understanding of the concept. Income approach we will follow. So this is the general background. Now let me remove this thing. I'll clear this thing, but you can see it in recording. When you will be seeing recording, this text will appear. So I'll just remove it and we come back to your book. So it says that government grant IAS 20, accounting for government grants and disclosure of government assistance, is a fairly straightforward standard that you have seen before, like in F7. The main points are summarized below. Grants are recognized until there is reasonable assurance that the conditions will be complied with and grant will be received. So you only recognize when you see that conditions are being met. Grants are recognized in profit or loss. So this is what they are telling you, that you should be following the income approach. Don't use the capital approach. With the related costs, they are intended to compensate a systematic basis. Like I told you that as you are meeting the conditions, you are incurring some costs, and in order to match those costs, you are showing the related revenue. Government grants related to assets can be presented either as deferred income. This is one which I showed you, or by deducting the grant in calculating the carrying amount of the asset, or the otherwise you can take it to the asset thing. Grants relating to income may either be shown separately or as part of other income. So you can show it separately or you can show it as in other income. Like don't put it into your main revenue side. When you present it on income statement, show it separately so that we know that in your school, your overall revenue is, I don't know, 100,000. Out of that 100,000, 5,000 is coming from the government grants. It's a presentation issue so that the investors, shareholders, they know that how much of the revenue is coming from that grant format. And government grant that becomes repayable is accounted for as a change in accounting estimate in accordance with IAS 88. It becomes repayable. Repayable means that probably for some reason you are not meeting conditions, or you could not meet the condition, so you must return the grant. As I told you, it is your liability. If you are not achieving or meeting the conditions, it is a liability. You must be returned. And then you can make it a change in estimate and go back and change your revenues, go back and change the transactions which you made before. So this is quite simple, straightforward. And there is one simple activity exercise. You can read it. It's not something very difficult. So we wouldn't be spending a lot of time on this government grant. So I'll skip it. And you can see my PowerPoint slides. Then we come to the topic which is called borrowing cost. This topic we already have covered, and your lecture is already uploaded there. And you should watch that video. It is detailed in, quite comprehensively. It has been explained. Now we come to our next topic, which is called IAS 19 employee benefit. This will start today.